In this chapter we're going to look at three applications of discounted cash flow analysis. First of all, we're going to look at how to deal with a situation where you don't have enough cash to fund all of your available projects. This links back to chapter 2, where we looked at the idea of businesses operating with constraints. A key constraint is the lack of cash. We're then going to look at adjusted present value, which is probably the most important topic in the chapter. This links back to chapter 9, where we looked at Modigliani and Miller theory, and it shows how to amend present value analysis if gearing changes as a result of a project. Finally, we're going to look at the idea of real options, which is the idea that projects sometimes give you some strategic flexibility which needs to be borne in mind as you do your NPV analysis. All of these are reasonably important topics for your exam. Okay, starting off with capital rationing. Where you don't have enough capital to fund all of your projects, this may be because the capital markets won't release the funds to you, which is called hard capital rationing. This will often be the case for small to medium-sized companies. Or it can even be the case for large established companies that a division can't get all of the capital expenditure that they want because the group is trying to keep its gearing under control and doesn't want to take on too many projects at once, and therefore introduces artificial internal capital limits. So with soft capital rationing, you can get the cash, but you've decided not to. In either case, we have to be able to manage capital rationing effectively. How to deal with capital rationing will depend on whether a question tells you that a project can be split up and done in part, in other words, it's divisible, so you can choose to do 5% of it, 10% of it, whatever proportion you want, or whether it's the type of project where you've got to do all of it or none of it. So for example, if you're launching a major new product in the UK, perhaps a new razor blade, you might be able to launch it as a national campaign, selling it around the UK. You're very unlikely to be able to justify selling it in one county. Some projects you either have to do them or not. Questions will clearly say whether projects are divisible or indivisible. If they say that a project is divisible, it means that the project can be done in part. And that means that you've got control over every pound that you spend. So you can look at all the projects that you're considering and rank them by taking the NPV that they deliver for every pound spent. This is called the Profitability Index, and you do need to learn this definition. We'll look at a lecture example in a moment, but basically you choose the projects that give you the best return per pound invested. This is only relevant if you've got a choice over how to invest each pound, if the project can be done in part. If the project is not divisible, then you'll simply look at all of the projects that you can afford and choose the combination that maximises your NPV. We'll work the numbers in a minute, but there'll always be a discussion area, and you should be comfortable noting that if you find it difficult to get a bank loan, a lease might be available, or a joint venture with another partner might be possible, or maybe you can delay one or more of the projects to a later period. You could mention whether you could issue new capital, but almost by definition, if you've got a capital rationing problem, that's unlikely to be feasible. Okay, let's have a look at a lecture example. In lecture example 1, we're told that a company called YT Inc. has got a limit of 40 million euros for capital spending. This limit is for next year. Next year it's identified 4 capital projects that it's going to invest in. Each of these projects will require some outlay this year as well, but it's next year that we've got the problem. The projects will also start to bring in cash from next year as well. So focusing on the net cash flows next year, with project number 1, we will have a net of 32 million spent and 8 million coming in. With project number 2, 20 million spent, 8 million coming in. And projects numbers 3 and 4, net cash flows of 14 and 8. And if we add those up, it exceeds 40 million. So we have a capital rationing problem. We're told that our cost of capital is 10%. And in requirement A, we're told to assume that the projects are divisible. And because they're divisible, we've got a choice of how to spend each pound, and we can apply the Profitability Index. The NPV over the outlay. So to use this, first of all, we have to calculate the NPV of the 4 projects, and I'll show this for project number 1, but for the other projects it's exactly the same calculations. Okay, looking at project 1, the cash flows are given in the question, and we're going to discount them at 10%. Discounting from time period 1 to infinity, you've got a discount factor of 1 over R, which you should have seen before, but it is actually given on your formula sheet. So 1 over 0.1 gives me a discount factor of 10, and I can quickly work through and calculate the present value. And I can see that project number 1 has a positive NPV of 32.9. For projects 2, 3 and 4, the time periods are exactly the same, so the discount factors are exactly the same. So I'm just going to show the NPVs for these other projects. The NPV for project number 4 is actually negative, so we're not going to do this. So going back to the cash flows, do we still have a capital rationing problem? Yes, we do. Next year, even if we disregard project number 4, we'd still need 50 million of capital spending, and we've only got 40. So for the remaining projects, we're going to take the NPV and we're going to divide by the outlay, but it's going to be the outlay in the year in which we have the capital rationing problem, and this is next year. So project number 1, what's our outlay next year? Well, we already know it's the 32 million net of the 8 million, so it's 24. And we're going to take that 24 and calculate the profitability index. Here the profitability index is 1.37. On the same basis for projects numbers 2 and 3, we get profitability indices of 3.48 and 4.16. And that tells us that the best way for us to invest our money is project number 3, then project number 2, and then project number 1. So our plan will be to go for project number 3 first of all. The outlay required for project number 3 is 14, which we can afford. So we'll get all of that project's NPV of 58.2. Next we'll do project number 2. The outlay required next year here is 12. So again we can afford 100% of it. We'll get 100% of the NPV of 41.8. Finally, we'll go for project number 1. Now we've only got 14 million left to take us to our 40 capital limit. Project number 1 would cost 24 million in total, so we can afford to do 14/24, which is 58.3%. So we'll get 58.3% of the NPV, which will be 19.2. Adding up the three NPVs, the best we can do, assuming divisible projects, is to get an NPV of 119.2, and we'll get that NPV if we go for 100% of projects 2 and 3 and 58.3% of project number 1. So that's the Profitability Index. Now we'll go back and look at Part B. In Part B, projects are not divisible, so there's no point working out the return that they give us per pound invested, because we don't have a choice on investing each pound. So with this approach, we're not going to work out the Profitability Index, we're just going to look at the NPV, which we've already done. So in Part B, we're just going to look at what we can afford. We've got 40 million. Can we afford project number 1 with any other project? Well, we know that project number 1 causes a net cash outflow of 24, project number 2 causes a net cash outflow of 12, and project number 3 causes a net cash outflow of 14. So with project number 1, we can afford either 2 or 3, but not both. We can also afford projects 2 and 3. So we just add together the NPVs. For project 1 and 2, the NPV would be 74.7. For project number 1 and 3, it would be 91.1. And for project 2 and 3, you've got the best NPV. So the plan would be to fund projects 2 and 3 only. Earlier in Chapter 9 we looked at Modigliani and Miller theory. Modigliani and Miller theory of capital structure suggests that where corporation tax is payable, debt finance is always good. And debt finance is good because it saves corporation tax. Now we can take this simple insight and apply it to project appraisal. If a question asks for a project appraisal using APV, you'll need to go through 2 steps. In step 1, where we can see that a project uses a lot of debt finance, we appraise the project as if it didn't use any at all, using an ungeared cost of equity. And we can do that because we know that according to M&M theory, all debt does is save you some tax, and we can quantify that separately by working out the present value of the tax saved, and also taking into account any other financing costs like the cost of issuing the loan in the first place. We'll demonstrate APV by working through an exam standard lecture example. In lecture example 2, we're thinking about a fairly simple project that requires an investment of 11 million now and will yield 2.9 million after tax for 5 years. The complication is that we're going to finance this project mainly by debt. The example says that we've got the capability of borrowing 8 million, presumably because the project involves an investment in land and buildings against which we can secure a loan. And because we're using Modigliani and Miller theory, we're going to assume that we exercise all of that capacity because debt is good. We're going to pay 5% interest. The cost of the loan being raised is 200,000, and then we're given some information about our beta factor and the rate of tax. Finally, we're told that currently we have £1 of debt to £2 of equity. So clearly this project's very different, using lots of debt finance. And because of that change in gearing, we're going to use adjusted present value to appraise it. We'll work through this together. The solution is set out with the 2 steps involved in APV. In step 1, we look at the project as if no debt was used. This requires the calculation of a cost of equity ungeared, and that means that we will need an ungeared beta, or an asset beta. In step 2, we'll look at the effect of using debt. But focusing on step 1 for now, you've already seen a formula for ungearing a beta. In this question, our geared beta is 1, and we've got £2 of equity for every 1 of debt. 1 minus t is 0.7. That simplifies to 2 over 2.7. I'm not given a debt beta, so I would assume it's 0. And anyway, I'm told that I can borrow at the risk-free rate, so the debt beta must be 0. So the answer here, the ungeared beta, is 2 over 2.7, which is 0.741. And now that I've got my ungeared or asset beta, I can put it into the capital asset pricing model. And that gives me a cost of equity of 10.187%. And because I've used an ungeared beta, it's an ungeared cost of equity. That's the rate that I'm going to use to discount my project. And that's very important in APV, to ignore the debt to start with. So now, taking that discount rate of 10.187%, I can discount the project. So discounting at 10%, just rounding it to the nearest whole number, I have a present value of negative 11 for the outlay, and then of slightly less than that. So my MPV is basically 0, but on my numbers it's slightly negative. And that's the end of step 1. The project, as if ungeared, is marginal and probably slightly unattractive. The only effect of using the loan of 8 million, on which we pay interest of 5%, is that because we can deduct our interest payments from our taxable profit, we get tax relief. And we're going to save tax in this question at 30%. So that's going to be a tax saving of 0.12 million per year for 5 years. And we can discount this. Now, we're not going to discount it at 10%, and the reason for this is that this cash flow is not risky. We definitely pay the interest, and so we're pretty sure of getting the tax relief too. So we're going to discount at the cost of debt, which is 5%. And discounting at 5% for 5 years gives us the present value of the tax relief at 0.519 million. That step's important. It's important that you use the cost of debt, because that reflects the risk of the cash flows. Finally, we've got issue costs. Issue costs are given in the question as 200,000 net of tax. So my adjusted present value will be from step 1. The project itself is marginally negative. And then from step 2, I've got the present value of the tax saved, and I've got the issue costs. And if I just add them through, that will give me my adjusted present value. And we would say that this project is acceptable. It's acceptable because it allows us to borrow money to underpin the project, and it's the tax relief on that loan that makes the difference. Remember that this is a Modigliani and Miller theory and can be criticised by criticising that theory. In addition to the drawbacks of M&M theory that we described in Chapter 9, we're also making the assumption here that we wouldn't have got the loan without the project. That will often be the case. But it might be the case that you would have borrowed this money anyway, that you had a bigger plan to change your gearing, in which case this approach would not be valid. Finally, you may come across the difficulty where you're trying to use APV, but you're not given a beta to ungear. And in that case, lecture example 3 shows you an approach that can be used. lecture example 3 is the same as lecture example 2, except that it's been slightly rewritten so that you're given the cost of equity that it currently has, and this is a geared cost of equity because the company has debt. But you're not given a beta factor, so you cannot ungear the beta. In this case, where you're trying to do step 1 in APV, you'll need to find another way of calculating the cost of equity ungeared. In this case, we need to work out the company's existing weighted average cost of capital. And we've got its cost of equity, and we've got its cost of debt, and we know the tax rate. We also know that the company has £2 of equity for every £1 of debt. So we can quickly work through and calculate the weighted average cost of capital. We can then take this 9.167% and use the Modigliani and Miller formula for the weighted average cost of capital, which we looked at in Chapter 9. So we know the weighted average cost of capital is 9.167. We know the tax rate is 30%, and that this company has got £1 of debt to £3 of debt plus equity. That's the leverage figure. We're trying to work out the cost of equity ungeared. So working this through, 9.167 equals 0.3 times a third is 0.1, 1 minus 0.1 is 0.9, and then divide both sides by 0.9 and you'll have your cost of equity ungeared. And just as before, it's 10.19%. It's just that this is a different way of getting there and a method that you might need to use if you're not given a beta factor. The rest of the example, in terms of step 2 and the APV, is exactly the same as before. Finally, it's worth noting that international investments often use a high degree of debt finance. So APV could be examined in that context. And just as one extra frill, if you were ever told that you were able to get a special subsidised bank loan to encourage you to invest in a particular area of the country, then you've got to be slightly careful with APV. If the loan was free, for example, that would obviously be good news. But in terms of APV, you'd have a problem in step 2. Because you're not paying interest, there's no tax relief. And that doesn't make any sense, because clearly if you've got a subsidised loan, a zero interest loan, that must be worth something. So where you're faced with this situation, you should work out the benefit of the subsidy, how much interest has it saved you, and calculate the benefit of that net of tax relief. Discounting as part of step 2, so discounting at 5% if that's your normal cost of debt, as we did in step 2 of the lecture examples that we've just gone through. Finally, you need to be aware that discounted cash flow techniques can't capture all the benefits of investments, and in particular they've been criticised for ignoring real options. A project might have strategic options such as being easy to abandon because it's got assets that are easy to sell or can be redeployed. If it had those characteristics, it would be more attractive, but you wouldn't have captured that benefit in the NPV. Some projects create brand name or technological know-how that may well be useful in the future. Again, that could be a very powerful strategic benefit, but it's ignored in traditional NPV. Finally, in many NPV analyses, we ignore the option to wait to get new business information. So, for example, if there was a general election due in a few months' time, then that could affect the prospects of your investments. So perhaps, whatever the NPV is now, it would be better to wait. In the exam, you may well have to identify real options and to comment on them. We'll do this in lecture example 4. In example 4, we have to identify the real options present in two investments. Both investments are linked to the manufacture of solar panels, and the first one involves building a customised plant with specialist staff. This plant can only be used to construct solar panels, so there's no option to abandon there. It would, however, build your profile, and if it's helpful in building a strong brand name, it could mean that you've got the option to expand or to follow on. So the option to follow on is present in that proposal. In proposal B, we're going to use more expensive machinery, but in our existing premises, and these could be adapted. So this carries an option to abandon. Finally, both proposals probably have a valuable option to wait because a general election is expected that will affect the growth of the industry. As part of a question, you may well have to pick out these sorts of strategic options. It's also possible that you might have to do some numerical work, and this is illustrated in the final example in the chapter. Lecture example 5 is pretty much a worked example. It looks at a proposal to buy a powerboat for 200,000, and this will give an outcome in time 1 which might be 110,000 with a 30% chance, or it might be 75,000, or it might be 25,000 with a 30% chance. So if I work that through, 0.3 times 110, 0.4 times 75, and 0.3 times 25. And that's working in thousands. If I add them up, that comes to 70,500, which is an example of expected values. Exactly the same calculation has been done for time 2 and time 3. And I've then taken these expected values and discounted them and worked out a present value that is negative. And I've worked out that negative NPV by adding up my present value of the inflows and then subtracting the 200,000 investment. Underneath these numbers there's a little bit of debate. The management accountant has argued that the project ignores the value of an option to abandon, and the details of this are that you've got the right to sell the boat back to the supplier at the end of year 1 for 90,000 if you want to. So let's have a look at how we could amend the analysis to take this into account. At the end of year 1, if we've done very well, then we'd be anticipating cash flows of 115 and 120. So we wouldn't sell the boat back to the supplier at the end of year 1 for 90,000. We'd keep going. So those cash flows don't change. At the end of year 1, if we've had an average year, then we'd be expecting in the next 2 years cash flows of 195,000, and even without discounting them, we can say that that's better than 90,000 selling the boat back to the supplier. However, when we get to the end of year 1, if we've had a bad year, we would rather sell the boat back to the supplier then experience 2 more bad years. So what we're going to do is sell the boat back, but only under that circumstance. So how it changes the cash flows is that in year 1, if there's a bad outcome, you sell the boat back. So that's going to give you 115,000, but you'll get nothing in years 2 and 3. Nothing extra. So we'd have to rework the expected values based on these new numbers. The revised expected values are shown. They've been calculated in exactly the same way. So for example, year 2, 115,000 times 30%, 90,000 times 40%, 30,000, nothing times 30%, add that lot together and I get 7,500. Building in the option to abandon, this is now an attractive project. And there's the breakdown just showing you